Tax implications of divorce and separation in Canada. Hi, my name is Allan Madan from Madan Chartered Accountant. Today, I will reveal the 6 major tax implications of divorce and separation in Canada. Divorce and separation can be an extremely emotional and difficult time in your life. To make matters worse, these life changes can lead to unwanted financial stress. Nevertheless, there are various tax savings opportunities that can help you save money throughout your marital transition. Number 1, split your family assets. You should consider the after-tax cost of family assets when splitting them up upon separation or divorce. For example, assume that you and your spouse both own a family home, which has a fair market value of $400,000. Your spouse has $300,000 of RRSPs and $100,000 of non-registered investments. Your share of these assets is $400,000, or 1/2. Upon separation, which assets should you ask to keep? In making this important decision, your goal is to maximize the after-tax value of your share of these assets. If you keep the RRSPs and non-registered investments, you would end up with an after-tax value of $260,000. This is because when the RRSPs are cashed in, a tax rate of 40%, which is the marginal tax rate in this example, is payable on the gross amount of $300,000 of RRSPs. Likewise, when the non-registered investments are sold, a tax of 20%, the capital gains tax rate in this example, is payable, leaving only proceeds of $80,000 after tax. However, if you keep the family home, you will end up with an after-tax value of $400,000. This is because you can claim the principal residence exemption on the sale of your home, making the entire amount tax-free. In summary, you should ask to keep the home and let your ex-spouse take the non-registered investments and RRSPs. Number 2, do not cash in RRSPs. Do not cash in your RRSPs when splitting up family assets. There is a special rule in the Income Tax Act that allows one spouse to transfer his or her RRSP to the other spouse upon separation or divorce. This is very helpful if you have to make an equalization payment to your spouse. If you do not take advantage of this special tax rule, then you will end up having to cash in your RRSPs, which are fully taxable, in order to make an equalization payment to your spouse. Let's take the example of Jenny and Sam, who are in the process of divorcing each other. Their total family assets have a market value of $1,650,000, or $825,000 for each of Jenny and Sam. Jenny wants to keep the family home and artwork, while Sam wants to keep the RRSPs, which they both agree to. With this splitting of assets, Jenny will receive $350,000 less than Sam, because the RRSPs are worth so much. To be fair to both Sam and Jenny, Sam makes an RRSP transfer, that is an equalization payment, to Jenny's RRSP account for $175,000. After the transfer, Jenny and Sam end up with $825,000 of assets each. Number 3, update the CRA with your new marital status. If you have children, it is particularly important to update the CRA on your new marital status after you've been separated or divorced. The Canada Child Benefit that you receive for your children is based on family income. This includes the combined income of you and your spouse. If you are separated or divorced, then only your income will be factored into the calculation for the Canada Child Benefit that you're entitled to. Your spouse's income will no longer be part of the equation. Therefore, it's likely that you will receive an increased amount of the Canada Child Benefit by changing your marital status to either separated or divorced. Number 4, split your property ownership. If you and your spouse own 2 properties together, then allocate 1 property to each of you. As a result, each spouse can separately claim the principal residence exemption. Number 5, certain legal fees are tax deductible. If you have to pay legal fees to your lawyer to collect support payments, then those legal fees are tax deductible on your personal tax return. However, legal fees paid to your lawyer to prepare a separation agreement or for disputes going back and forth on the split up of family assets are non-tax deductible. Number 6, claim the eligible dependent tax credit. If you have children through joint custody, then decide which spouse gets to claim this credit. Both spouses cannot claim the credit. In conclusion, these 6 major tax implications will ultimately help you save money during your divorce or separation and lessen any financial stress during your marital transition. For more tax tips, please click on the subscribe button below and visit our website. Feel free to follow us on Twitter, Facebook, Instagram, and Google+. Don't forget to like, comment, and subscribe to our YouTube channel. See you soon, and thanks for watching.